Intermediate Accounting 14B, Earnings Per Share, and 4 Ways to Show Dilutive Earnings. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, the email, and the website. And I'm going to refer to a blog that I did a while ago on March 5th, 4 Ways to Dilute Earnings. And then we need to have as a starting point the definition of earnings per share, which is defined broadly as net income divided by outstanding shares of common stock. Now you'll note that I put common stock. Let's just keep it to common stock for the purposes of this conversation. There are lots of ways to come up with different versions of earnings per share, but we're going to keep it simple and say common stock. So I mentioned that in this sentence. Now this brings up a second point that I think is misunderstood if you haven't worked in the brokerage business. I did it way back at the beginning of my career. This is a tough concept to understand. Issued, authorized, outstanding shares, and also common stock. So let me explain these concepts because I think it's a little tricky. Issued shares refers to shares sold to the public, where the company sells shares and gets cash in exchange, sold to the public. Outstanding shares is slightly different. That means shares held or owned by the public. So there's a difference between shares we issued, we sold, and shares that the public owns. And that difference is because we have treasury shares. We have shares that were issued and repurchased by the corporation. So if you can think of this formula, issued shares less treasury shares equals outstanding shares. Keep that formula in mind, because it's possible for a company to buy back shares, repurchase them, that they've issued to the public originally. And then finally, authorized shares, I always mention. The maximum number of shares a company is allowed to issue, that's normally stated in the company's corporate charter way back at the beginning. I'm familiar with a situation where a company fraudulently issued far more shares to the public than they were authorized to do. That does happen. So now we can move to dilutive earnings per share. If you take a look at the earnings per share formula above that I just did, you'll see that the denominator of that equation is common shares outstanding. So for example, if your company earned $5 per common share and you had 100 shares of common stock outstanding, your earnings per share would be $5 divided by 100. I'm sorry, earnings per share, $5 total, not per share. You earn a total of $5, you have 100 shares outstanding. $5 in earnings divided by 100 shares is 5 cents a share. That's your earnings per share as a starting point. Now let's think about dilution. If you mix Kool-Aid with water or any sort of drink mix, the drink mix is diluted, it thins out. That's how I try to remember dilution. And if you apply that concept to earnings per share, you'll see that if your common shares increase, common shares outstanding increase, but your earnings stay the same, $5, your earnings per share will go down because what's happening is your numerator, the $5 your company earns, stays the same. I'm going to correct that. But your shares in the denominator are different, and therefore the earnings per share declines to 25 cents. Larger denominator, common shares, generates a smaller earnings per share. So moving down a little bit farther, there are several kinds of securities that can cause dilution. And the issue here is that there are securities that allow the holder to convert the security into common stock. And when you consider dilution, what you should think about is, let's assume that all securities that can be converted into common stock are converted, because that would allow you to see the maximum number of common shares investors could potentially own. I've got videos and blogs on some of these, but let's talk about the 4 examples. Call options on stock. A call option buyer pays a fee and owns a right, and it is a contract. The buyer has the right to buy a certain number of shares of common stock at a certain price we call the exercise of the strike price, for a certain period of time. So if the buyer chooses to exercise, they're going to purchase more shares of common stock. Oftentimes, stock options are granted to employees as an incentive to stay with the company and help it grow because they can profit long term if the price of the stock goes up. A warrant also allows the owner to buy common stock. A warrant is usually issued with a bond, because if you issue a bond with a warrant, the bond is now more attractive to the potential buyer. If they own a bond and a warrant, not only do they earn interest on the bond, but they also own a warrant that allows them to buy common stock. So the buyer is participating in both the company's debt, the bond, and in equity, the possibility of buying common stock. The phrase preferred is misunderstood is another thing I find. Preferred stock is slightly different from common stock. There are a few reasons why a stock might be considered preferred. Really, two big reasons. For one thing, the preferred shareholders are in line in front of the common shareholders in getting a dividend. They have priority. If the company liquidates, preferred shareholders are in line ahead of common shareholders if there are assets left after a liquidation. So preferred shareholders have a claim on assets that comes before common shareholders. So if you have a convertible preferred stock, that means that you have the opportunity to convert from preferred stock into common stock. And finally, we have a convertible bond, which allows a bondholder to convert a bond into shares of common stock. And the details on that conversion, how many shares of stock do I get, what price per share do I pay, are stated on the bond certificate. That way, the owner of the convertible bond always knows what the terms are if they choose to convert. So since all four of these securities that I just named can be converted to common stock, they're all considered dilutive securities for earnings. Because the outstanding shares of common stock would increase, the earnings would stay the same, and earnings per share would decline. That's as far as we're going to get on this topic. I did want to mention one more thing, which is if you look at the website stltest.net, which you'll see coming up here in a minute, I teach a course called The Toughest Accounting Courses, which is a summary of 5 topics that I'm asked about most frequently by students. And so you can see here we have upcoming courses. They'll be taught throughout the year. These are the areas that I'm asked about for tutoring the most, and so I'm doing small group classes, 90-minute sessions, limited to 10 people, to help with these tough areas. Thanks very much for watching, and we'll see you next time.